So Mervyn King says government spending cuts will eventually curb UK rises here in this country, but will he be proved right? As a former UK Treasury official, Neville Hill is well placed to answer this question. He's now Director of Economics for Developed Countries at Credit Suisse. And I'm pleased to say that he joins me now. Thank you very much indeed for speaking to us.
Hi there.
So tell me about the biggest challenge facing Governor Mervyn King right now.
I think there's a couple, to be honest. I think, the challenge he's been facing for quite a while is clearly the problem that inflation has been a lot higher than the bank's target and has been substantially higher for a long time, substantially higher than the Bank of England has actually forecast itself. So from that perspective, it's become increasingly hard to justify the extraordinarily low level of rates. So, and I think that's one of the reasons he's finding it difficult to sort of argue his case on the committee.
Sorry to interrupt you there. Does he have a point? Will spending cuts curb price rises as we go forward?
I'm not sure that they will. I mean, clearly, in the public sector in the UK, we're in for a pretty slow period of growth, but there's lots of evidence to suggest that outside particularly the domestic economy, things are growing very quickly, particularly in manufacturing and exports, which should, I think, sort of continue to keep the economy pretty strong. And the reality is that we've had a very deep recession already, and what's been a pretty unremarkable recovery, and yet, inflation hasn't behaved in such a way to that weakness as the Bank of England and indeed others would have expected.
But nevertheless, surging to 4% in January, double their target, right?
Absolutely, and I think the other reason I think this is a problem for Governor King is that you've got another central bank just over the channel that has responded pretty aggressively to inflation just being 0.4 percentage points above its target. So I think from that perspective, it puts a lot of pressure on the Bank of England, if only just because if the bank doesn't start to follow the ECB in raising rates, then I think there's a genuine risk that sterling could weaken and generate inflationary pressures.
So does an imminent rate rise, or indeed a rate rise in April, as Jean-Claude Trichet has indicated may be the case, put a great deal of pressure on the Bank of England now?
I think it does, and I think to some extent it shows that perhaps the Bank of England is slowly losing control of events here, because particularly if the ECB was to move and the bank wasn't to follow it, I think there'd be a big risk that sterling would fall, and that would precipitate another round of inflationary pressures such as we saw after the last big depreciation. So I think from that perspective, the bank is increasingly put into a corner here, and if it doesn't follow the more aggressive stance of the ECB, it may find itself having to deal with a devaluation of sterling and a renewed bout of further upside pressure on inflation.
So what does this mean? And a rate hike when? This year? How soon?
I think we'll be looking at a rate hike as soon as May. I think the bank have steered us in that direction, and I think to some extent they're now sort of increasingly duty bound to deliver that, unless there's some really serious financial or economic accident before then. And I think after that we'd probably be looking for another couple of rate hikes by the end of the year, so rates up to 1.25% by the end of this year, and maybe
1.25%.
Yeah, and then maybe up to 2.5% by the end of 2012.
Neville, I've got to say, we had economic contraction in the final quarter at the end of last year. Service industry growth slowing. Banks are keeping a lid on credit to consumers. Mortgage approvals are down as well. Tell me about the risks of raising rates too quickly. Do we risk jeopardizing the recovery?
I'm not sure that we do. I think there's a risk that by not raising rates, the bank could jeopardise the recovery far more seriously further down the line if inflationary pressures continue to rise. You only have to look at price expectations of businesses, manufacturing firms, retailers, service companies. These are all sky high. Companies are not behaving like they take the Bank of England's inflation target seriously, and if the bank does have to take radical action at some point to correct that, that's going to be far more serious to growth than a very slow iterative increase in policy rates that I'm not sure will have an altogether severe impact on the economy. I mean, we're only talking about rates rising to sort of close to 1% by the end of this year. That is not a high level.
Okay, well, I could actually I've got so many more questions to ask you, but next time. Neville Hill, thanks very much for speaking to us. Good to talk to you.
Thank you.
Director of Economics, Credit Suisse.